Chapter 12 is on nonprofit organization earned income strategies. In this first slide, we talk about an introduction to earned income. What is earned income? Earned income is income from payment for goods or services that the nonprofit has provided. So when the nonprofit provides goods or services that people pay for, it's called earned income. Contrast that to contributed income, and that would be income from gifts or donations. Now that is not for payment for goods or services, which earned income is. Contributed income is income from gifts or donations. So know the difference between those two. Most revenue in the nonprofit sector is earned income, especially in the education and healthcare subsectors. So earned income is the majority of the revenue, especially in the education and healthcare subsectors of the nonprofit organization. The majority of government revenues or funds received by nonprofit organizations are earned income. Now these would be things such as payments for goods or services provided, such as Medicare and Medicaid. So the majority of government revenues or funds received by nonprofit organizations are also earned income. The 2008 study by Duke University indicated that over 40% of nonprofits in the United States and Canada currently operate a nonprofit business venture. And a nonprofit business venture is also called social enterprise. And so that's what we're going to talk about in the next slide. So now we're going to talk about the terminology of earned income. There are two prominent examples of earned income strategies, and this would be the approach to earning income. There are partnerships with business organizations, and there are business ventures undertaken by the nonprofits themselves. So those are two primary types of earned income approaches or earned income strategies. Now this is an area where the terminology is somewhat unsettled. So you'll hear earned income referred to as social enterprise, affirmative business, nonprofit business venture, earned income ventures, community wealth, social entrepreneurship. So those are all terms that you will hear associated with earned income strategies. In this graphic illustration, we're going to talk more about earned income strategies so you can see it depicted in this type of format. So you'll see the box on the left, earned income strategies, divided into two. Above we have the corporate partnerships, and below we have the business ventures. So the first earned income strategy we're going to talk about is corporate partnerships. Those are further divided into components such as licensing, sponsorship, cause-related marketing, and other, which would be operational relationships and joint ventures. And then when we talk about business ventures, those can be divided into services, products, distribution, and retail. So those are the primary earned income strategies we're going to be discussing. Now, what would the reasons for nonprofit organizations be for adopting earned income strategies? The book is a discussion that divides the reasons into two sections, pushing and pulling factors. When we talk about push factors, we're talking about the decline in government funding for social programs, the shift toward a voucher approach in government funding, the use of competitive contracts in government outsourcing, as well as the increase in the number and needs of nonprofit organizations. So those would be factors that push the nonprofit organizations toward adopting earned income strategies. Now we talk about the pull factors, and that would be including diversifying sources of revenue, thereby gaining protection from changes in government funding. Using earned income strategies to help advance specific missions, increasing focus and sharpening goals and management skills throughout the organization, as well as increasing visibility via partnerships and promotion. Those will be the items or the factors that are pulling the nonprofit organizations toward earned income strategies. Partnering with for-profit businesses. True partnerships between a nonprofit and a for-profit are relationships that advance the goals of both the nonprofit organization and the business. Read the discussion that contrasts the partnerships with corporate philanthropy and also discusses that partnerships are not necessarily earned income strategies. So that talks about the differences between pure earned income strategies and partnerships. So do understand that partnering with for-profit businesses is one approach to earned income. The most common types of partnerships: licensing agreements. Now this is where a for-profit pays for the use of a nonprofit's name or logo on its products. Sponsorships, where the for-profit pays for the use of its own name or logo in connection with the nonprofit's products or events. Cause-related marketing ties the nonprofit's income directly to the number of for-profit sales, representing a partnership where both parties' interests are aligned. And then lastly, operational relationships. And this is where the nonprofit acts as a supplier, improving the training or recruiting services, offering benefits for employees, or serving as a test site for new products. A type of operational relationship would be a joint venture. And that's where new initiatives are undertaken jointly by the two entities. So understand all of these common types of partnerships: licensing agreements, sponsorships, cause-related marketing, and operational relationships, as well as joint ventures that are a type of operational relationship. Now, when we talk about successful partnerships, there's a discussion that talks about the obstacles to successful partnerships between nonprofits and for-profits. Read through all of that in the book, but understand the common obstacles are language and communication between the nonprofit and the for-profit, the differences in cultures, the status of the nonprofit and the for-profit, the differences in worldview between the twos, and the bottom lines of the nonprofit and the for-profit and the differences between those. Building successful partnerships. In your book, there's a discussion about successful partnerships having a logic to them. You'll read the example that is between Home Depot and Kaboom in Reader's Digest, and Reading is Fundamental. Those illustrate successful partnerships with a logic to them. Strategies for Nonprofit Organizations, in a study by Sagawa and Siegel in 2000, say that building successful partnerships begin with self-understanding, that each organization understands what they're all about, and that successful partnerships seek out partners with comparable values. If they engage in discussion and they conduct their due diligence, they use small-scale tests before expanding the partnership. So these are components to successful partnerships. Nonprofit business ventures. There are three principal activities that are included in nonprofit business ventures. They would be, 1, services. So a nonprofit business venture could be services. 2 would be manufacturing or producing a product. And 3 would be distribution or retailing of a product. Examples in your book about nonprofit business ventures include the retail stores operated by Goodwill or Salvation Army, DC Central Kitchen and Fresh Start Catering, Triangle Residential Options for substance abusers. Now the caveats when we talk about nonprofit business ventures, earning income from commercial ventures is often no easier than earning income from donations. So that's something to keep in mind, that it's not easier necessarily to earn income from a commercial venture than it is from specifically soliciting donations. And there's also an extremely high failure rate for small businesses, which would be true also for nonprofit small businesses. When you go about creating a nonprofit business venture, it is important to identify the business opportunities. What are the marketable assets? What are the market opportunities? What are the organizational capacity for entrepreneurial activity? And that's no different than a for-profit business. So a nonprofit would go through that same process of identifying the business opportunities. The next step would be conducting the feasibility analysis, looking outward, the size, the outlook, the competitive factors, the ease of entry, and the profitability. Looking inward, the fit with the mission, the skills and expertise, the material resources, managing risk. Sensitivity analysis in a social enterprise business indicates how projected results could vary if the business plan and assumptions are wrong. So how do things change if the assumptions that you make would be incorrect about your social enterprise business? That is called sensitivity analysis. So this discussion is about what is the feasibility of the business. Then the next step would be creating the actual business plan. The business plan is a detailed, comprehensive document. It encompasses elements of strategic marketing, business, and operational plans. Internally, it is used as the guide to developing the business, and externally, it is used as a sales document for enlisting donors or investors. Who is responsible, ultimately, for making the decisions regarding a nonprofit's business venture? Well, that responsibility belongs to the governing board. What are the elements of a business plan that the nonprofit would put together? Well, the first element would be the executive summary. This is where the summary of the business plan is the first item in the business plan. Then there's the description of the business that they intend to put together or to launch. Then there is the management and organizational structure and key personnel section. Next comes the marketing analysis and the marketing plan. Then a description of the products and or services that will be part of this business. The operational plan, how does it operate on a day-to-day basis? What are the financial assumptions? Then a detailed financial plan, which would include the budget and the projections. Then a section on uncertainties and risks. And then finally a plan for growth or exit. So those are the primary elements of a business plan. Now, it may vary somewhat from this, but these are the basic foundations of any business plan. So how do this business venture and the nonprofit organization relate to each other? Well, 60% are separate departments or divisions, so those operate completely separately. There are also subsidiaries which are incorporated into the organization, which would not necessarily be a separate department or division, but they could operate as a subsidiary. They could be a completely separate entity. They could also be what is called an L3C, and this is a low-profit limited liability company. This is something for you to know about, and it's a new development. It's a cross between a nonprofit organization and a for-profit corporation. Essentially, it's a for-profit company with a social purpose. This permits the investors to receive a moderate return, but the L3C is not a tax-exempt organization, and that's what differentiates it from the 501c3s we've been talking about. So these are the different strategies or approaches to how the business venture and the nonprofit organization are actually related. Keep in mind that 60% operate as a separate department or division. There's a discussion in your textbook about the concerns of earned income strategy approaches by nonprofit organizations. Are there limits on public access to nonprofit goods and services if the nonprofit has a business venture? Are there government funding issues related to nonprofit organizations using earned income strategies? Is there concern about the balance between public interests and the nonprofit organization's need for revenue? Could there be limits on the transparency and the disclosure due to contractual agreements if the nonprofit operates a business venture? And what is the role of perception in public relations? Do you erode the confidence in the nonprofit if you operate a business within the nonprofit organization? Are you creating the impression that the nonprofit no longer needs the donations or other sources of support? So there's a discussion about the concerns related to earned income strategies that you'll want to be sure to read and understand. This is a graphic depiction of evaluating earned income opportunities by nonprofit organizations. And you can see here in this graphic where it gives a nonprofit a tool in which to evaluate whether or not an earned income opportunity would be something they might want to undertake. On the left-hand side, there's profitability, break-even, and loss creation, and then across the top, there's mission enhancing, mission neutral, and mission threatening. So, for example, if you have profitable and mission enhancing, you might want to undertake that. If you have profitable and mission neutral, it's a possibility of undertaking that. And if it's profitable and mission threatening, you'd want to scrutinize, adjust, or not pursue that. So then you move on to break even and whether or not you should undertake or avoid it. And under loss creating, mission enhancement, mission neutral, or mission threatening may want to be avoiding or reconsidering those. So this is just a tool in evaluating whether or not the nonprofit organization should consider the earned income strategy and opportunity. In this final slide about earned income strategy, we need to look at opposing perspectives as they relate to determining if a nonprofit organization should undertake an earned income strategy that would be basically a business venture for the nonprofit organization. Now, there are two primary opposing perspectives. And in this case,